Hello, this is Vinay Navani at Wilkinson & Guttenplan. Welcome to our webinar today, Strategies for Reducing Your 2015 Tax Bill with a special focus on business. Joining me today speaking is going to be Lauren Landolfi, one of our tax managers. Some of you are signed up to get continuing professional education. If you are, there are going to be some polling questions throughout the presentation. It's very important that you answer the polling questions. Doesn't matter if you get them right or wrong, but you've got to answer them. And there will be evaluations emailed to you that you will have to send back, and then your CPE forms will be sent to you via email. This presentation will also be recorded on our website, www.wgcpas, and up in a few days. So if you'd like to replay it or share it with some colleagues, you can feel free to do so. And also on that same web page, yesterday we had a similar presentation with an individual focus. So if you missed yesterday's webinar and you want to get some more ideas as it relates to individual taxation, you may want to check that out. So having said that, let's just jump right into our outline for today. So these are the main areas that we're going to cover: the political landscape, provisions for depreciation, cost recovery, retirement plan benefits, what to do about gains and losses that you might have, tax credits for business, miscellaneous other considerations, charitable tax planning as they relate to business, and the dreaded alternative minimum tax. So let's talk about where we are today in terms of our 2015 landscape. Today is December 2nd, 2015, and this is really where we're at. We're in a world of uncertainty, especially as it relates to some of these provisions. What is becoming, unfortunately, a commonplace situation is that tax laws seem to only be extended for 1 year at a time, and they expire, and then it's not until the very last days of December that they get extended retroactively in some cases. Some cases they don't get extended at all. And so we're kind of in this waiting game. If you just read the news about tax extenders, you're going to see a lot of discussions and debates in Congress right now as to what's going to happen to these hundreds of provisions that have already expired on December 31st, 2014, and will they be extended hopefully retroactively to January 1st, 2015, but we really just don't know at this point. So let's jump into depreciation ideas and provisions. So just as means of background, if I have a business and I spend $1,000 on a computer, generally speaking, I don't get to deduct that full $1,000 in the year that I spend the cash. The IRS has tables that tell me that for a certain type of asset, this is what the depreciable life is, and I get that depreciation. I get to recover my $1,000 over time based on what that IRS table tells me in terms of how many years and over what kind of method. In most cases, it's some sort of accelerated depreciation that gives you the benefit early on. Now, there has always been a provision of the tax code known as Section 179 expense, and that's really designed to help give businesses the benefit of saying, okay, some portion of that money that I spend in the current year can be immediately expensed, and that historically has been $25,000, and it phases out at fixed asset purchases of $200,000, meaning that if I acquire less than $200,000 of assets during the year, up to $25,000 can be expensed. Now, going back to about 2008, Congress has used Section 179 as part of its toolkit to kind of stimulate the economy. And Section 179 in the past, since 2008, has been as high as about $200,000 of assets that could be immediately expensed, not the $25,000. But as of December 31st, 2014, that special allowance for Section 179 at the higher threshold stopped, and we went back to the historic $25,000. So the way the law is on the books today, only $25,000 can be expensed. A lot of people are waiting and hope that in the next few days before the end of the year, that will be increased to something closer to $200,000, meaning that you can deduct up to $200,000 of fixed assets placed in service before the end of the year. Now, we're going to talk about bonus depreciation in a minute, but while we're still talking about what's known as Section 179, Section 179 can be used for purchases of new or used equipment. We're going to now talk about bonus depreciation, and bonus depreciation is a provision that only applies to new equipment. Now, bonus depreciation has been also part of that congressional toolkit that's been around since 2008, that basically has said that if I put in service an asset before the end of the year, I can immediately write off 50% of the cost of that asset under this special bonus depreciation provision, and the remaining 50% is subject to the normal depreciation rules. The bonus depreciation was on the books and expired as of December 31st, 2014. And as we stand here today, there is no bonus depreciation. Again, we are hopeful that bonus depreciation will get extended retroactively through 2015. Now, the fact that the enhanced 179 and bonus depreciation are not yet retroactively reinstated or even reinstated at all really puts businesses in a tough place, because you can't order a forklift via Federal Express. It takes time to make these capital purchases and plan for them. So, many businesses have made the capital expenditures expecting Congress to repeat itself and extend these provisions retroactively, but we really just don't know. So it is a little bit of a dilemma for this. Now, an important requirement for any depreciation provision, whether it be regular depreciation, 179, or bonus, is the property has to be placed in service by the end of the year to qualify for any sort of depreciation benefit. So something like a computer is relatively easy. You plug it in, you hook it to your network, and it can be done, in a matter of hours. But something like a dentist chair, for example, requires electric connections, plumbing connections, contractors. It takes time to line that up. So just ordering the dental chair on a credit card isn't going to qualify. Having the dental chair delivered to your office is not going to qualify. It's got to be installed, ready to go, ready for patients to sit in the chair to have that tax benefit by the end of the year. So that's another challenge that you always have to keep in mind when it comes to depreciation and fixed assets. One other set of items relating to depreciation, which again is off the books now, but we're hoping comes back, is special write-offs for leasehold improvements, also certain types of restaurant improvements and retail improvements. For the most part, these are the interior fit-out costs for office space and restaurants and retail space. Under this provision, you were able to to depreciate those costs over a 15-year period, which is quite a bit faster than the normal statutory period of 39 years. So that was a very big benefit for many businesses. We're hoping that it comes back, but right now we just don't know. So now that takes us to our first polling question. There is certain uncertainty with respect to depreciation deductions that will be available for 2015. True or false? So I hope we didn't make that question too hard for you. Please be sure to answer the question, the polling question. We will keep it up for another 20 or 30 seconds. And do we have any sense as to how many people have answered it? Okay. Be sure to answer the polling question so you can get the CPE credit. Okay, so why don't we close out the question, and of course there is an uncertainty. We don't know what's going to happen for 2015. So let's change gears now. Let's talk about retirement plan options. So qualified retirement plans are one of the great tools for businesses, because if you can meet the requirements, and there are a bunch of requirements, the businesses are getting a deduction today, and the employees and the business owner who are getting the benefits will not have to recognize the income for many years in the future until they reach retirement age and start taking distributions. So because of that great benefit retirement plans provide, there are a number of hurdles that are associated with retirement plans. The biggest one is this concept of discrimination, meaning that if I have a business and I have employees, I can't put away all the dollars in my retirement account and not do something pro rata for employees. And that's the basic underlying concept of all these retirement plans. So we're going to spend just a few minutes talking over the most common types of retirement plans that many businesses will have. So probably the most common one that we see is a SEP IRA. It can be a self-employed business. It can be an LLC, a corporation, a partnership, S-Corp. The employer is going to make contributions based on employee salary, based on some percentage. There are limits up to how much can be put in, up to $53,000 in any individual accounts. Often that times that will be the owner's contribution to the owner's account, and the employees are going to be getting their pro rata share based on their salary. The great thing about SEPs is you don't have to form a SEP or fund a SEP until the tax return deadline of the business making the contribution, and that includes extensions. So if I'm a sole proprietor taxpayer, I have a sole proprietor business, I have until October 15th of 2016 to create and fund a SEP for 2015. So it may be that as I stand here today, my cash is very tight. I can't afford to make any sort of SEP contribution, or I don't even know if I want to go through the expense of setting up a SEP because I don't know what my financial situation will be. I actually have, another 9 months to figure out and see how things are looking and what my financial situation is in the fall of 2016 to see if I want to take this benefit on my 2015 tax return. So for that reason, SEPs are very common. The downside to SEPs is the contributions to the employees is a straight pro rata percentage of payroll, and it's the same for everybody across the board. So there's not a lot of flexibility that a SEP offers in finding ways to fund the employee's account. Simple IRA is another animal that we're not going to really talk about because the fund that does have a setup deadline of October 1st due to some notification requirements to employees, but there's some other information there if you want to read more about it. A 401k plan is something that many of us see and have heard about. And what it allows is there's really two pieces to it. A 401k plan allows an employee to defer a portion of their salary, and it also allows an employer to make a match either based on salary or based on the profits of the company. So in terms of the employee deferrals, an employee can defer up to $18,000 in salary, or if they're 50 or older, up to $24,000. They don't have to do the full thing. They can do a portion of it. And then the employer can make matching contributions, either matching payroll or a profit-sharing contribution that's limited to 25% of compensation, such that no more than $53,000 can go in each individual person's account. And I'm looking at the plan setup deadline October 1st. I think that's really December 31st, right? Or is it October 1st? October 1st, okay. There may be variations on the 401k that have a later deadline. I'll have to check that. But in any event, what needs to be done by the end of the year is the employee deferrals have to be made, but the employer contribution can wait until the extended due date of the tax return as well. So the employer has time to fund the contribution. They do have to commit to it when they set up the plan, so there's not the same amount of flexibility as a SEP because you have to know what you're going to do, but you do have time to make that contribution in a 401k. Where a 401k can be really powerful is if you're in the type of business that doesn't have any employees. It may just be the business owner and maybe perhaps the business owner's spouse. In that case, the 401k can be a great opportunity because you can put away, $53,000 per person. Before we go on to the next topic, the three types of retirement plans we spoke about are things known as defined contribution plans, where the amount that goes into the business owner's or the employee's account is defined up front, and whatever it grows to, it grows to. So the other concept that we don't have any slides on is something called a defined benefit plan, where the benefit to the employee or to the business owner is based on what's the promise that I'm going to make in the future in terms of giving out a pension to that person. And depending on the nature of the business, the age of the employees, sometimes that can yield a much greater tax deduction. So if your census is that the business owner is relatively older relative to the rest of the workforce and there's not that many other employees, sometimes looking into a defined benefit plan can yield a huge deduction. That is something that you have to consult an actuary to do, to run tables to figure out what's the allowable contribution in any given year. So I didn't want to leave that the topic of retirement plans without at least introducing the concept of a defined benefit plan. So with that, now Lauren is going to speak about managing gains and losses.
Great, thanks, May. Okay, so the first thing we're going to talk about is if you're looking at a position where you have some capital gains this year, you may be in a position to harvest some capital losses to negate those capital gains. So what happens from a very basic standpoint is when you're filing a tax return, you look at total gains and offset them by total losses, and any net gains are going to be taxable, and any net losses could potentially provide a tax deduction depending on what type of entity you are. So for our individual taxpayers, up to $3,000 of capital losses will be deductible against other types of income. Now, the one thing to watch out for with respect to harvesting capital losses are washed-out rules. So what happens sometimes is we have clients that have realized capital gains for a year, and they obviously don't want to pay tax on those capital gains if they can avoid it. And they have some losers in their portfolio, and they want to harvest some of these losses. But the stock that they're looking at, may be something that they think is going to rebound, or there could be a change, in the market, and something could turn. So the washed-out rules tell you that if you repurchase that stock, there's a 31-day look-around from the date of the sale that generated the loss. And if you repurchase that stock within that 31-day period, then you will not be able to deduct the loss. So if it is a position that you would like to repurchase, just make sure you wait past that 31-day window to ensure the deductibility of that loss. Now, we also would like to have people harvest capital gains in order to neutralize capital losses. This is a strategy that's particularly important for New Jersey residents. Reason being is that for federal purposes, capital losses are carried forward until they're utilized. So you can have gains to eat those up, or again, individuals can deduct up to $3,000 a year. But for New Jersey, there's really no carryover provisions with respect to capital losses. It's a use it or lose it principle. So for taxpayers that are looking at a capital loss, they may want to sell securities at a gain just to neutralize that capital loss in order to ensure the benefit of that loss. Now, that washed-out rule I was referring to with respect to losses does not apply to capital gains. So if you do have a stock that you sell to harvest a gain, but it's a position that you really do like and it's a good investment, then it may make sense to just sell the stock and repurchase it, immediately after selling the stock. And basically all you've done is stepped up your basis in that position while utilizing that capital gain and neutralizing that capital loss. Okay, so next we're going to talk briefly about Section 1202, which is a small business stock gain exclusion. Section 1202 is really, driven and written to encourage new business and new ventures. And this is going to apply to C corporations. So if you own a C corporation stock and you were the original holder of that stock, and you held that qualified small business stock for greater than 5 years, then you can have a 50% gain exclusion on that qualified stock sale. Again, it needs to be something that you were the original holder and that you held for more than 5 years. Now, there is pending legislation that would exclude 100% of the gain for stock that was acquired before January 1st, 2017 and held for 5 years. Now, this kind of mirrors 100% gain exclusion provision that was, instated a couple years ago. And the dates for those, it's January 1st, 2010?
Yes. It was September 27, 2010 to before January 1st, 2014. That window of time, there's a 100% gain exclusion.
Okay. So if you currently are looking in that window, that 100% gain exclusion is still there. This pending legislation could create, an additional 100% window. But as it stands right now, the current law does allow for a 50% gain exclusion, which could be a really nice benefit.
And this is also something people who are starting businesses will want to take advantage of, or at least take into consideration as to what kind of business form to choose. So during that window of time between in 2010 through 2013, I did have some clients that would otherwise have been set up maybe as S corporations or LLCs that decided to set up as a C corporation to get that benefit at some point after the 5-year holding period was obtained.
Now, the reverse to Section 2 is really Section 12 to 44. So typically what happens is if you're a holder of C Corp stock, if you sell that stock, it's really an investment. So it's treated as either a capital gain or a capital loss. And what Section 1244 does is it allows taxpayers that are holding these qualified securities to treat that capital loss as an ordinary loss. So it's something that typically would be treated as a capital loss, subject to the regular capital loss limitations, as an actual ordinary loss. And up to $50,000 of that ordinary loss for unmarried individuals, or $100,000 of the loss for married individuals, would be treated as ordinary as opposed to capital. Now, any losses in excess of those thresholds would still be treated as capital loss. So you're not going to lose them, you just lose the ability on that excess to have ordinary loss treatment. The next thing we'll talk about with respect to gains and losses is going to be worthless stock. So worthless stock is a little tough to define because there really needs to be some fixed and identifiable event that creates the worthlessness. And so a lot of times the IRS may agree that this stock really is worthless, but it comes down to a matter of timing. Was the stock really worthless in the end of 2015, or was the stock worthless at the beginning of 2016? And as you can see with these various gain-loss provisions, sometimes the date in which the loss is actually identified becomes very important from a tax planning standpoint. So unless there is some fixed or identifiable event that occurs, claiming that worthless stock deduction can be a little gray. So one thing we can suggest to you is if you do have stock that you believe is worthless, but there could be some issues as to the timing, why don't we consider selling those shares to a third party for $1, so that now we've created a true event, a sale or exchange. There's really no gray area. It's the stock is no longer yours, and so by selling it for a nominal amount, you've ensured that loss is deductible in 2015.
Now, Lauren, what if you do that? You sell it to your friends for $1, and then a few months later, the stock rebounds and now is worth $100,000.
You sold it now.
You've sold it.
You're done.
So your friend made out.
Right, exactly.
Okay.
Okay, so next let's talk about Section 1031 exchanges. So what 1031 allows you to do is really defer capital gains. And the 1031 exchange is really, it's called a like-kind exchange. So what you do is, it's easy to think in terms of houses or rental properties. You take one rental property and you swap it for another, or one home and swap it for another home. And this is what taxpayers do when they're looking at selling a piece of property for a gain. And by simply swapping that home for another home, you can then defer that gain as opposed to paying tax on that gain. And then your basis in the replacement property is just adjusted by that deferred gain. Now, the timing with these is very important. So whenever we have clients that are looking into doing a 1031 exchange on their property, we really suggest that a qualifying intermediary be used to help facilitate that transaction, because there's a lot of rules and regulations with respect to these exchanges, and it's critical that it's done correctly. If it's not done correctly, then the 1031 exchange won't be honored, and you'll have to, pay tax on that gain, and you still obviously own that replacement property. And
just to add a little more detail, like Lauren said, there are a number of rules to making a 1031 work, but the most important rule is that if you're the seller, you can't touch the money. So the only way this is going to work is if you plan for this in advance. I can't tell the number of clients that come to us after a sale and say, okay, I sold my property, I'd like to buy another piece of property, how do I do it and get the exchange? It's too late at that point. It's got to be well planned out before the exchange. And also the only properties that are eligible for this are business or investment purposes property. So even though we use the word home, we mean, a residence being, rented out would be an example of something that qualifies. You couldn't use it for a personal residence to take advantage of this.
Right. All right, our last topic under this gain loss management subset is going to be installment sales. So in the simplest example I can give you, an installment sale is really when the sale occurs in year one and the proceeds occur over several years. So if you have a property that you're selling in 2015, but half of the proceeds will be sold in, or will be received in 2015, and the balance of the proceeds will be received in 2016, you're only entitled or required to report half of the gain in 2015 and half of the gain in 2016. So the installment method really matches the gain to the year that the proceeds are actually received. Now, installment treatment is required unless elected out of. So it may make sense for certain taxpayers to elect out of installment treatment, but just note that installment treatment is required unless you affirmatively elect out of it. Now, the next take over.
So now we're talking about business tax credits. And why do we like credits? Because a deduction will reduce our income, and then that will give us a lower taxable income, then we have a smaller tax. But a credit offsets tax dollar for dollar. So a credit is far more powerful than a deduction. So we like credits. So we're only going to talk about 2 or 3 common business tax credits. There's many of them. One of them is the research tax credit. And this is actually a credit that also expires at the end of every year, and Congress almost always extends it retroactively. In fact, this credit has been part of the ins and outs of the tax code for much longer, and I think it's always been extended. So most businesses are pretty comfortable with the fact that the research credit will be around, even though we're still waiting for it to be extended. So when people think of research, they think of people in white coats and laboratories. And certainly that's part of research, but there's a number of research for purposes of this credit is much broader than that. It's really dealing with some amount of uncertainty, and it can be uncertainty in terms of an existing product that you're manufacturing, adapting it for a new use, figuring out, new ways to new uses for things, new ways of doing things. Basically, you're trying to get from point A to point B, and you're not really sure how you're getting from point A to point B, and the risk of loss and the expense of getting from point A to point B is something that your business is incurring. You can't move that risk to a third party and say, I'm only going to pay you a success fee if you can figure out how to get to point, design this new product that I want. So that's the concept behind the research tax credit. Lots of different applications that we have on these slides here that qualify. So the calculation of the credit is actually pretty complicated, but the really easy dummies approach to the research tax credit, if I'm a new company, a startup company, I'm effectively going to get 6% of my qualified research expenses. The research expenses the IRS believes are truly, that meet this definition. The 6% of that number is going to be a tax credit that will reduce my tax liability. Now, many startups don't have a tax liability because they're still starting up and they're losing money. Well, this credit carries forward until the company starts having a tax liability. So what we'll often have is companies that are in that early loss phase will come to us during that loss phase. We'll do the study, and we'll bank all these credits, and they'll be available when the taxpayer first has a tax liability. And like I said, the credit expired last December, but we're fairly certain it will come back to be available this year. There is a tax credit for companies that are adopting a retirement plan. We spoke about different types of retirement plans a few years ago. There is a credit for the cost of actually putting together a plan to help encourage employers to set these types of retirement plans up for their employees. Oftentimes, businesses will have to incur some construction costs to make their premises more handicapped accessible. So there is also a disabled access credit to the extent that you're doing interior work that specifically allows the business to comply with the ADA, things like, the wider doorways, the ramps, elevators, things like that. So there is a credit of up to $5,000 if you incurred expenses like that. And so now we get to our second polling question. Research credit is to encourage research and development activities. Again, another tough one for you on a Tuesday afternoon. Please answer the question so we can move on with the presentation. We'll keep the polls open for another 20 or 30 seconds. And why don't we close the polls now? And of course, the answer is true. Another credit is called the Work Opportunity Tax Credit, and this is a credit designed to encourage employers to hire employees from certain groups that the Congress has targeted. Some of these are people who formerly were on public assistance, people who were unemployed for a long time, certain military veterans, certain ex-convicts. There's a group specifically listed types of groups. And there is the credit is on a per employee basis. Many of these, the mechanism for doing this is a form that should be integrated into the hiring process, where the employee self-selects which of those groups they might be part of, and then it's sent to the state workforce development office to verify. Many of the larger payroll companies will actually provide services where they help integrate this with the onboarding process. So if you're a business that has a lot of employees, this may be something that could be very fruitful to you. Companies like restaurants, amusement parks, lots of businesses like that hire a large number of people often make out very well under this credit. And that we're going to talk about a few other things. Oops, too far. Okay.
Okay, so we're going to go into some other items, but first let's talk about some nuts and bolts tax planning. So what our typical strategy is. So typically, what we're trying to do is have our taxpayers accelerate their deductions while deferring their income. So it's a two-step process, but it's done at the same time. And the goal is to try to get our 2015 income as low as possible. So by bringing any deductions we can into 2015 and deferring income into 2016, we're in the best position. Now this is, most easily done, by our cash basis taxpayers, because we can manage our income a little better that way. Now, the other thing we can do is manage our C Corp earnings. So for our C Corp taxpayers, we are, looking at year ends, and obviously we want to keep our C Corp income as low as possible, because by doing this, we are, limiting the C Corp tax that we're paying and limiting our exposure to any double taxation. The best way to do this is usually achieved through bonuses at year end. So compensation to owners or other employees through year end bonuses. I would suggest that maybe we don't bring C Corp earnings all the way down to zero or negative, because it makes estimated tax planning a little more difficult. So there are some safe harbor provisions for C corporations that if you have a small amount of income in 2015, then you can base your 2016 estimates on 2015 income. Now, if a C Corp has no income or has losses in 2015, then that safe harbor provision of basing estimates on 2015 doesn't apply, and 2016 estimates have to actually be based on 2016 income, which would require, projections throughout the year, or, could it require you actually paying in more throughout the year in 2015.
And just to put this strategy in context, when we talk about using bonuses to help manage this C Corp income, the bonuses still have to be reasonable in their amount, because what the IRS doesn't want is the company to be really distributing what would otherwise be dividends, which are non-deductible, and disguising them as salary. So if I'm working as a, as an executive of a company, and I also happen to be an owner, but, if I go out and try to get the same job, somewhere else, and my pay range was, call it 200 to 400,000 a year, I would be hard pressed if I'm also the owner to pay myself a bonus of $2 million a year, to give an extreme example. The IRS would likely say that, okay, maybe 300,000 of that is really compensation, but $1.7 million really is a dividend, and it would increase the corporate taxable income because the dividend, of course, is not deductible. So we just have to keep that reasonable compensation threshold in mind.
Right, and I think it's a little easier for a service industry to offer these year-end bonuses than a different type of industry.
Correct.
The other thing we're going to want to do is for our S corporations, our partnerships, our LLCs, make sure you have an understanding of what basis is. In order for the owners that ultimately receive the K-1s from these entities to take a deduction, they need to have basis in that entity to take the loss. So doing some planning by year-end could make it easier. The other thing with respect to C Corps and managing their earnings, or just businesses in general, if you are looking to make an additional payment, bonus payment at year-end, if you are on the accrual basis, you may be able to actually accrue that by 12/31, and as long as it's paid by 2.5 months after year-end, by March 15th, you can actually deduct that on your 2015 return. So that's just a distinction whether you're accrual basis or cash basis. Our approach is really going to be different to year-end bonuses.
But that year-end bonus, the 2.5 month rule doesn't apply to an owner.
Correct,
right?
correct.
Okay.
Yep, that's only for the employees.
The employees, okay. So now let's talk about another tool called the Domestic Production Activities Deduction, or DPAD. So DPAD came around, I want to say maybe 10 years ago, and the whole idea was to stimulate U.S. manufacturing. And conceptually what it is if I'm a manufacturer, what I'm going to do is I'm going to create a separate P&L, which is a subset of my taxable income, and I'm going to look and say, what is the profit that I'm getting from my manufacturing operations? So if I'm doing both like service and manufacturing, I'm going to strip out the service piece of it. I'm just going to look at the manufacturing revenue, and I'm going to look at the manufacturing expenses, and then allocate a fair value of general overhead expenses. So whatever that profit is, I'm allowed a deduction for tax purposes, which is not a book deduction, of 9% of the profit that I've achieved from that production activity. So if I'm in manufacturing, this can be a great opportunity for a tax benefit, a deduction of 9% against my taxable income. The types of, when we think of manufacturing, we think of, assembly plants and building cars and things like that. But it also applies to things like land building, land excavation, software development. So the concept of manufacturing is more broad than what you might typically think of. And also in the last 2 years or so, the IRS clarified the use of contract manufacturing because that's becoming so common these days. So to make a long story short, if I'm a taxpayer and I hire a contract manufacturer, and really all the benefits and burdens of ownership are with me, the taxpayer, not with the contract manufacturer, and the manufacturing itself done by the contract manufacturer is taking place in the United States, I as a taxpayer might qualify for the domestic production activity deduction. So it is something to give some thought to if you've never thought about it before. The other thing that's available that we see for companies that are either builders or tenants in buildings that are incurring rehab costs is this ability to take a deduction of up to $1.80 per square foot based on energy efficiency appliances installed. Things like lighting, heating, windows. It gets pretty complicated. You have to have a baseline engineer's report, and then based on the type of appliances that you are installing, if you meet certain criteria for reduced energy usage, you will get up to $1.80 per square foot deduction. There are different sub-thresholds in getting to the $1.80. You might not qualify for the full $1.80, but you might qualify for pieces of it. So that is also something to think about if you are in the process of doing a building renovation. Right now, that is off the books, but again, we're hoping that it does come back on the books as part of the tax extender package being discussed right now. So now Lauren's going to talk about some charitable angles to consider as we approach year end.
Okay. So we're probably going to switch to more of an individual focus for the last 10, 15 minutes or so, just to make sure our business owners are, also considering what they have going on personally. So for our taxpayers that are charitably inclined, now is the time to start considering any year-end contributions. Contributions need to be made by December 31st of 2015 in order to ensure a 2015 tax deduction. For somebody that wants to make a cash contribution to a charity but can't do so right at December 31st, a credit card charge by December 31st will count as a 2015 deduction regardless of when the bill is paid. So credit cards are a way to ensure a deduction for 2015. Now, with anything in the charitable realm, it's very important to remember the substantiation rules. The IRS is very strict when it comes to these rules to make sure that in the event of an audit, you can actually support the deduction that's claimed on your return. So when you get those receipts from these charities that you're supporting, make sure that you store them away in your tax files and hold them for the required amount of years in order to ensure that if you are audited, the IRS will be able to allow that deduction. Now, in addition to cash contributions, taxpayers can also make non-cash contributions. And a nice non-cash contribution that offers some benefits is going to be securities. So if you're holding stock in your portfolio and you've held it for long term, which is greater than 1 year, and it's appreciated, so you have a potential gain on this security, it may make sense to actually transfer that security directly to the charity. By transferring the security directly to the charity, you've now avoided paying capital gains tax on that gain, and you also receive a fair market value deduction for the value of that donation. So it really results in a two-step approach. You don't have to pay the gain on that appreciation while still ensuring that same deduction. Again, it's important that the security goes directly to the charity in that case. Now, if the stock is depreciated, so you're looking at a loss position, then you're going to want to take a different approach. You're actually going to want to sell the security in that case, and then transfer the cash from your account to the charity. This allows you to take the benefit of the loss while still getting that same fair market value deduction. So before you start thinking about gifts of security, make sure you have a clear understanding of what your position is as far as whether you're at a gain position or a loss position with respect to that investment. In addition to gift securities or other typical non-cash donations, clothing, household items, volunteers that incur out-of-pocket expenses could also take those expenses as a deduction on their tax return. A great vehicle for charitably inclined individuals are going to be donor-advised funds. So these are vehicles to get a tax deduction today while paying out contributions to charities over a number of years. And there's no time limit as to when those donations need to be made. So these donor-advised funds, they're recognized 501c3 charities, and they're usually set up with brokerage houses. So our Merrill Lynch or Fidelity, they are able to create and help oversee these accounts. So a donor-advised fund, the year that you set up the account and make the contribution to that donor-advised fund, that's the year that you're going to get a tax deduction for that donation. And then you will advise the Fidelity, the Merrill Lynch, how the donor-advised fund contribution should be made out in future years. Now, when do we use these? We use these in years that you have some type of transaction that created an unusually high income year or some unusually high one-time gain. And what that allows you to do is really max out your charitable contribution deduction in the year that you had that large one-time gain. But it still allows you to fulfill your charitable wishes over a several-year period. The nice thing about these donor-advised funds is that the fees are much lower than maintaining and managing a private foundation. So it gives you a similar type strategy that a private foundation offers with a much lower cost and much lower oversight requirements. Okay, last we are going to discuss some AMT highlights. With respect to AMT, this is really a dreaded word for most clients, and it stands for the alternative minimum tax. And the alternative minimum tax is a parallel tax calculation to our regular tax calculation. So when we're preparing our clients' tax returns, we're actually doing these two tax calculations side by side. Now, just a little background, for a regular tax calculation, we actually have a graduated rate of tax. So our tax rates range from 0% all the way up to 39.6%. But each level of income gets taxed at the lower rate, and once you get above that threshold, then your income gets taxed at the next higher rate. So you get the benefit of all of those lower brackets before you start paying at the higher rate. The converse is AMT, and AMT is actually a flat tax, and it's a flat rate of either 26% or 28%. Now, in recent years, we've actually seen a lot of our taxpayers kind of coming out of AMT, and a lot of them are getting excited about that because, you know, people just really do not like the idea of paying AMT. But the reason that we're actually seeing some taxpayers come out of AMT is because our regular tax rates have gone so high, and they're all the way up to 39.6%, that, you know, it's a much higher rate at 39.6%. And I should mention that when we're doing these two parallel tax calculations, that while most people would prefer to pay the lower of the two tax rates or the tax amounts that we calculate, the IRS and the laws tell you that you need to actually pay the higher. So when we do these computations, if we get to value A and value B, AMT versus regular tax, whatever one is higher is what the taxpayer is going to pay. As far as AMT, alternative minimum taxable income is generally not the same as regular taxable income. And what are the differences? So there is income that is subject to AMT that's not subject to regular tax. So what items do these include? Most commonly, we see incentive stock options, or ISOs, or tax-exempt interest from private activity bonds. That's income that is added back for AMT purposes, but not for regular tax purposes. Now, the other thing that we see are deductions that are not allowed for AMT, but are allowed for regular tax purposes. So these deductions are completely disallowed for AMT purposes. So you'll see the first one is state income taxes, and the second is state real estate taxes. Being in the Northeast, with high income tax rates, high property tax rates, this is actually the reason that a lot of tax returns we prepare in our office are subject to AMT, because with those deductions completely disallowed for AMT purposes, it's very easy to swing into AMT, in the Northeast. Some other deductions that are disallowed for AMT is going to be home equity interest, and that's only if the home equity line proceeds weren't put back into your residence. So if you take out a home equity line and don't improve your principal residence or one second home, but say you pay off a car loan or pay for tuition, whatever the proceeds were used, if they weren't put back in your home, then you can't deduct it for AMT purposes. And with respect to business depreciation, there are some differences between our depreciation calculations for regular tax compared to alternative minimum tax. Okay.
And Lauren, just to add a comment about this, at the beginning you said that these last two, the charity and AMT, were focused on individuals, and so many of the businesses that we deal with are in flow-through entities, whether they be partnerships or S corporations, where the business income is not taxed at the business level, but it flows through to the individual. So whatever that income from the business is, it does flow into these calculations that we're talking about right now. So this discussion, even though while it's an individual level calculation, it's driven by the business income. If I have a C corporation, there is a separate concept of AMT for C corporations, but that's something almost entirely different that we haven't really addressed here. Okay. And I think that takes us to the end. Do we have any questions in the question box? It looks like we don't. The last slide has contact information for Lauren and myself, and we thank you for spending an hour with us and listening to what we had to say. Feel free to email us if you have any specific questions, and if you want to go back and replay this, the webinar should be on our webpage within a few days. Thank you very much. Have a great rest of the day.
For those that are looking for CPE credit, you will receive evaluations in your email later on today. Make sure you complete those evaluation forms and send them back to us so that we can issue your CPE certificate.
Bye-bye.